I am 28 years old. Now, by the time I reach 50 in 22 years, I will be a millionaire. So, whatever your age, this plan, this video will make you wealthy. Make sure you watch till the end to see your age and your timeline on how you can become truly wealthy. Okay, so let's start off with the how. We're going to be looking in this video specifically at Standard and Poor, otherwise known as the S&P 500. Now, what is the S&P 500 and why am I using this example? So for me, the S&P 500 is one of my favorite investment vehicles. Standard and Poor, the S&P 500, is an ETF, an exchange traded fund, also known as an index fund. Now, this is essentially an accumulation of lots and lots of stocks, over 500 to be fair. Now, why would I use the S&P 500 over, say, one single stock? Well, with a single stock, there's a lot more risk. You're putting all of your eggs into one basket, into one single investment vehicle, if you like. And there's a lot of risk to that, because if the company does do well, of course, you're going to make a lot of money. But if it does bad, you're going to lose a lot of money. Whereas by using an ETF, exchange traded fund, or specifically an index fund like the S&P 500, you're spreading your risk because you're not putting it into one single stock, you're spreading it out across 500, which is great because it gives you much more opportunity for yielding greater results. And that's specifically how the S&P 500 has performed so greatly over the last decade or two. You know, we've seen great average annual yields of at least 10%. So that is what the S&P 500 is. Is it safe? Yes, the S&P 500 is considered safe. It's an investment that is seen to be good for building long-term wealth through compound interest with a relatively low risk and high reward ratio. Now, how long is this as an investment? Is it short term or is it long term? Well, for me, I think you can say that the S&P 500 generically is a long term investment. The reason for that is because when you invest on a dollar cost averaging basis, a regular consistent period, the idea is that the money you invest gains interest, and then you gain interest on your interest. So therefore, you're making money off of free money. And that's the whole benefit and the glory and the beauty of compound interest. Now, that's not to say that there's still not money to be made on the short term. You can definitely invest a lump sum and continue to invest smaller or larger amounts for a shorter period of time, maybe even a few months. And you can potentially start to see, returns in the positive on your investment. Now, maybe by this point, you've gone, okay, future investments, the S&P 500 sounds great to me. How do I invest in it? Well, there's multiple ways and multiple platforms. But for me personally, I like to use Trading 212. The reason being is because the platform to me is attractive. It's very easy to manage, very easy to use, and the fees are very, very low. There's no fee when depositing money into your index fund, but there is a selling fee, an exchange fee of, wait for it, 0.0008%. So it's extremely low, and that's what makes it extremely attractive. Now, moving on, my plan, my goal to be a millionaire by 50. So I'm 28 years old currently, and my plan is to retire at 50 years old. Well, how am I going to do that? I've worked out on the S&P 500's long-term investment calculator. So I'm 28. In 22 years, I'll be 50 years old. Now, the average annual yield for the S&P 500 right now is 15.57%. So I worked out that if I was to deposit £20,000, then continue to deposit £200 per calendar month, the total amount I would have invested would be £73,000. But the return on that £73,000 investment would be a whopping £1,070,000 tax-free investment. With the S&P 500, you're generically going to be using an ISA. The reason you want to use an ISA is because you can invest up to £20,000 or dollars tax-free every year. That would equate to £1,666 per month. If you go over that threshold, of course, you need to pay capital gains tax. So the idea is to invest, but stay below that capital gains tax threshold limit of £20,000 investable in the ISA. So of course, if you were to deposit the £20,000 in this tax year, you would then need to wait till the following tax year to be able to start investing the £200 a month. But nonetheless, an investment of £73,000 over 22 years, yielding me back £1,070,000, well, that's a very positive investment for me. Now, I worked out that if I do get that return, that 1.7 million back when I'm 50 years old, I could afford to pay myself dividends of £4,500 per month for the next 240 months. That would equate to me being able to stop working at 50 years old and pay myself that dividend of £4,500 every month for the next 20 years until I'm 70. Now, the best part about that is that because I would be paying myself in dividend funds from that £1 million, over the course of that 20 years, the remaining amounts of money still in that index fund would still be gaining me interest. So even when you get to the point of saying, okay, now I've reached my target, I want to start paying myself dividends, over the course of paying yourself those dividends over a long-term position, you're still going to gain interest on that investment. So I mean, it's just a really, really attractive investment vehicle. And when you start looking at the figures like this, you can see why. Now, I did take a look at other examples. There's two other examples I want to look at, a lower age bracket and an older age bracket, to sort of hit both demographics of my audience that are watching right now. So we're going to look at 18 to 50. Can you become a millionaire by 18 to 50? So the term would be 32 years. There's 32 years if you're 18 years old to reaching 50 years old. With the annual average return on the S&P 500 of 15.57%, you would only need to deposit £1 and you would only need to invest monthly, again the same amount, £200 per month, which would mean you would total up to £77,000 deposited over 32 years, yielding you an amazing return of £2.2 million. So from a simple investment of £77,000 over 32 years with a £1 deposit, your return on that investment would be £2.2 million. So it really does show how the scale of time can massively improve that. Just looking at my example, for me at 28 to 50, I'm getting 1.07 million back with a £20,000 deposit, but at 18 to 50, you don't have to put a deposit at all, or at least £1, and you're going to get £2 million back, so nearly double. Okay, so moving on to the older category, some of my, probably more of my viewers in the audience, 40 to 50. How can you become wealthy with that timeline? Okay, so you've got 10 years, 40 to 50. You want to finish off your financial situation really strong in those last 10 years. So if you deposited the same £20,000 like I am at 28 years old, you'd have to continue to put £200 a month in the following year. That means you would have deposited £44,000 over the course of 10 years with a return of £151,000 on your investment. So nonetheless, yes, it's not £1 million, but it's still a huge yield on your investment. Essentially, you're tripling your money on just a 10-year investment. So you can see how massively different it is between having time on your side and not, but nonetheless, you can still make great returns even if you're 40 years old. Now, in conclusion, some things we haven't mentioned. Inflation. We haven't factored in inflation to this investment. Of course, what the buying power of £1 million, £2 million, or the £150,000 return is not the same as what it's going to be in that 10, 32 or 22 years from now. The buying power is going to be completely different. Nonetheless, wouldn't it be better to have that money anyway? Yes, you can't beat inflation in the S&P 500. It's just not possible. You need to look at a commodity like gold if you want to preserve your wealth. But to build your wealth, you've got to look at this as an investment point on yielding returns on your capital. Yes, the buying power is not going to be what it is now compared to, decades from now, but nonetheless, you're still going to have a whopping amount of money on your investment. And also continue to invest in a diversified portfolio. Don't put all of your eggs into one basket like the S&P 500. Always spread your capital out across multiple different investment vehicles. That way you're spreading your risk, but you're also spreading your chance to yield greater results as well. And also, this example is based off of a compound interest scenario. When you put money into, say, gold bullion, you're preserving your wealth and you're trying to hedge against inflation. This is a totally different investment vehicle, and it really is about is compound interest, increasing that wealth periodically and consistently through the benefit of compound interest. Now, finally, I've got to say, time is your ally. However, having said that, I do believe that time in the market beats trying to time the market. So whether you're my age at 28 looking to retire at 50, whether you're 18 and you've got lots of time looking to retire at 50, or whether you're later on in life at 40 looking to finish on a strong financial position at 50 with 10 years to go, try not to be negative that you didn't start earlier, because hindsight is a wonderful thing and at least you can start now. And on that final point, I want to leave you with this. And that is that you don't have to be extreme, just consistent. Thank you very much for watching. I hope you've enjoyed this episode. I thoroughly enjoyed filming this one today. If you have stayed till the very end of the episode, please consider smashing that like button. It costs absolutely nothing to do, and it really does show me your support for the channel and for the video. If you've really enjoyed, consider subscribing if you haven't already, and leave me a comment below to let me know your thoughts. Until next time, I look forward to seeing all of you in the very next episode.